Is the Bajaj Allianz Life Fortune Gain 2 plan a good fit to complement your financial goals in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goal in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this about. So, this is a unit-linked, non-participating individual life savings insurance plan. And some of the key features of this policy are: you can get premium allocation of up to 99.5% for single premium of 10 lakh and above, and there are loyalty addition of up to 5.6% of your single premium based on your premium amount and the chosen policy term. You also have access to a selection of 11 funds for investment, and there is flexibility to make partial withdrawal from the invested funds. You also have the option to enhance coverage with your top-up premium. You have the facility to reduce your sum assured if required, and there is a systematic switching option for fund management. And finally, there is flexibility to receive your death and maturity benefit in installment through the settlement option. So these are all the key features of this policy. Now let's take a look at the benefits available under this plan. First, we have maturity benefit, which the policyholder gets once the policy matures. So the maturity benefit here is your single premium fund value plus your top-up premium fund value if you had any. So both will be available as the maturity benefit on the policy's maturity date. So another benefit is the death benefit, which the nominee or the legal heir will get if the policyholder unfortunately passes away during the policy term. So as you can see from the screen that your death benefit at the date of death would be either of these two options, either the prevailing sum assured or your sum assured percentage or your single premium fund value. So out of these two options, whichever is highest in value at the date of death, that will be given as a death benefit. Additionally, what will be given is either of these two options, which is your top-up premium sum assured or your top-up premium fund value if you had any. So out of these two options, whichever is highest in value at the date of death, that will also be given additionally to the death benefit to the nominee or the legal heir. Another benefit is a loyalty addition, which is expressed as a percentage of your single premium, which will be added back to your single premium fund value at the maturity date of your policy. So these are some of the benefits available under this policy. Now let us take a look at the 11 fund options available under this plan. So they are Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Pure Stock Fund, Asset Allocation Fund 2, Blue Chip Equity Fund, Bond Fund, Liquid Fund, Debt Plus Fund, Long Term Debt Solution Fund, Nifty Alpha 50 Index Fund, Nifty 200 Alpha 30 Index Fund. So these are some of the fund options available under this plan. And all these fund options are categorized based on the percentage level they have given to each asset class, like equity, debt or money market, and also according to the risk profile each fund option has, which ranges from low to very high. Now let's move on to understanding the various charges present in this policy, as this is a ULIP plan, which is a unit linked policy. So number one is the premium allocation charge, which is based on your premium amount. They will charge the premium allocation charge. And also there is something called policy administration charge, where 10 rupees every month, which is inflated every month at 5% per annum. So this will be subject of at least 500 rupees per month in any year. So this is the policy administration charge. Another thing is the fund management charge. So fund management charge is something they charge you for managing your fund options. So the higher the risk profile your fund has, the charges could also be slightly higher compared to a low risk fund. So the charges ranges from 0.50% to 1.35%. They also charge a miscellaneous charge of 100 rupees per transaction. And there is something called discontinuance or surrender charge, which depends on your annual premium amount, and here you choose to discontinue this policy or surrender this policy. But there is no such charge from the fifth policy year. There is no switching charge in this policy. But there is something called mortality charge, which they charge you for providing you with life cover. So mortality charge will be deducted at each monthly anniversary by the cancellation of units. So if you are a female policy holder, you will be eligible for an age setback of 3 years. So the thing is, investing in this policy comes with charges that are typically absent in other market linked products. Like if you choose to invest in a mutual fund, something like that, there is no like premium allocation charge or discontinuance charge. There's nothing like that. So these charges over time can erode your returns, potentially affecting your ability to build wealth in the long run. So these are all some overhead charges as an investor for you, which is also a drawback which you need to carefully consider before deciding to invest in it. Okay, now let's move on to understanding the advantages and disadvantages of investing in this policy. So the advantages are the systematic partial withdrawal of this policy allows you periodic withdrawal at a specified amount or percentage, and partial withdrawals can be made at any time after you complete the fifth policy here. And there is a flexibility to switch between your investment fund using the investor selectable portfolio strategy based on your risk preference. And you also have the option to make additional contribution through top up premiums, and you have the ability to reduce your sum assured as per your financial needs. You also have the option to receive your maturity or death benefit in installments. The systematic switching option, which is the SSO, initially invests premiums in a liquid fund and then gradually transfer them to the selected fund of your choice. So these are some of the advantages. The disadvantages are this plan lacks liquidity during the initial 5 policy years. There is no loan facility available under this plan, and also the sum assured provided by this plan may be insufficient to adequately meet the fundamental financial needs of a family. So these are all some of the drawbacks that you can get by investing in this policy. So carefully consider all these factors before making a choice to invest in it. Now, as we have a basic understanding of this policy, let's move on to analyzing the potential returns of this policy by calculating the internal rate of return (IRR) of this policy. So we can analyze the plan's performance properly. So now we are going to calculate the IRR based on the benefit illustration provided in the policy brochure. So let's just for example scenario assume that a 35-year-old male has opted for this policy with a policy term of 24 years. He pays a single premium of 2 lakhs and selects a sum assured of 8 lakhs. So at the end of the 24-year policy term, he receives the fund value as his maturity benefit. Now we are going to calculate the IRR based on two future assumed rate of return like 8% and 4%, which indicates the best and worst case scenario you can get from a policy. Because this is a unit linked plan and the actual performance of this policy will depend on how the fund performs over the years, we are going conduct the analysis based on these two assumed returns to give you a clear idea of what can happen at a worst case scenario and a best case scenario. These returns are non-guaranteed and they do not reflect the potential range of outcomes you can get from this policy. This is purely for example purpose. So at 4% return scenario, like at the worst case scenario, the fund value is 2.31 lakh with an IRR of 0.60% as per the policy's maturity calculator. This gives you literally no value addition to your investment portfolio because this return is nothing literally. So next is the best case scenario, which is a 8% return. So the fund value here in a best case scenario rises to 7.51 lakh with an IRR of 5.67%. This is still lower than the interest rate offered by many debt instruments, like even a bank FD can give you a better guaranteed return compared to this. But here in this scenario, as this is not even a guaranteed return, there is a possibility it can go even lower than this. So despite being a long-term investment with a 24-year horizon, the returns fails to outpace inflation. So the IRR here shows that this plan provides you with limited real returns, which can significantly hinder your wealth accumulation goals. As this policy is not giving us the desirable outcome that we need, what we are going to do now is we are going to conduct a comparative analysis where we are going to compare the potential return that we saw from this policy with other alternate investment option using a alternative investment approach. Instead of investing in an insurance come investment policy like this, we are going to separately invest in insurance and investment by using the same parameters as outlined in the previous example with the Bajaj Allianz policy. Let's just for example consider that for life cover purpose we have opted for a pure term life insurance plan which offers a sum assured of 8 lakhs and can be purchased for a single premium of 61,400 rupees with a 24-year policy term. So compared to the Bajaj Allianz budget for single premium, here we are saving 1.38 lakhs which is available for investment in other financial instrument according to our risk appetite. So for this analysis, we have selected a equity linked savings scheme ELSS fund for a more fair comparison because this is also a market linked investment option and particularly it is also a tax saving equity tool, and if you choose to consistently invest in it for 7 to 8 years, it has a previous track record that it can perform the average 12% return and also outperform in certain cases. So based on all these factors, we have chosen this for a fair comparison with the Bajaj Allianz policy. So the investment in this scheme grows to 21.03 lakhs, which is the pre-tax value over 24 years. But after deducting the capital gains tax, your post-tax value comes around to 18.73 lakhs. So the combined IRR for the pure term insurance and ELSS investment is 9.77%. So as you can see, this alternative strategy results in a significantly larger corpus and superior returns compared to the Bajaj Allianz Life Fortune Gain 2 plan. So investing separately in insurance and investment products not only provides better investment but also offers greater flexibility and liquidity. Now, what is the final verdict on the analysis on Bajaj Allianz Life Fortune Gain 2? Is this worth investing for the long term or not? As you can see from our analysis that we can understand, this is a policy which offers market linked investment opportunities, but its results are underwhelming due to high charges. Moreover, the sum assured here is inadequate to meet the long-term financial needs of a family. So, a market-linked product delivering returns comparable to a debt instrument does not benefit investors who took the risk of investing for such a long time in a product like this because they were expecting inflation-beating returns or even a better risk-adjusted return. But as the risk-return balance under this plan is misaligned. So, consequently, this plan provides no significant advantage and may even jeopardize your future financial plan, and it also has a high agent commission. So it is advisable to avoid insurance cum investment products like this and instead focus on building a diversified investment portfolio which is tailored to your financial goals and your risk appetite. So opting for a pure term life insurance policy is a more practical choice as it is cost effective, provides you with adequate coverage, and can be customized to meet your individual financial needs, ensuring your peace of mind. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.